Okay, hi there. My name is Sarah. I am a CPA CA, and my goal with this particular recording, I don't make recordings very often, but this has been a request for quite a few years. So my goal is to get this out there, is to walk through an example, a simulation of an individual, right here in Canada, an individual's personal tax return, just a very basic example. But my goal actually is to do this in three ways. One, which is the numbers, right? The technical, so manual calculation actually. So a little bit of an overview and then the manual calculation, which I think will be this recording here. And then two to three, I guess. Two would be to do that same example, but using an app like Wealthsimple. So applications like Wealthsimple, very friendly, that, any everyday person, non-professional can use to carry out their simple personal tax return obligations. So using that same example and actually walking through that. That's my goal. And then the third one actually would be to use a professional tax software. For example, Tax Cycle is what I use to go through again that same example and just show the outcome, which really should be the same outcome, but one being manual calculation. And of course, everyone can do it manually if they wish. Maybe they can, they cannot, but we often do not. We have software. And so maybe part two being Wealthsimple, part three, another software that's available. I think that would be interesting again if you're watching this because maybe just you're curious as an individual taxpayer, do I need to engage a professional or can I do this myself? Okay, well, this recording here is serving to give that background first, because again, we should have the same number at the end of the day. But for students, in the classroom, they're often asking, hey, we focus so much on the technical and the manual calculation, and in real life, we do use software. So just showcasing that a little bit more. So here we have person J as our example. And let's see if I can get this working. Yes, we're focusing on that personal tax return, the T1. Here in Canada, that's what we refer to in filing their personal income tax obligation, right? We as individuals are taxpayers. There are a few taxpayers here in Canada, and an individual is one of them. Okay, so I did mention this already, the game plan, right? Going through some basics and then walking through the manual calculation. And then, of course, maybe in a separate recording, we'll see how this one goes. Going through Wealthsimple, for example, very, very friendly, very user-friendly to go through those same case facts. And then we have Tax Cycle, that is a more professional program that we use, again, to carry out the personal tax obligation. So in terms of basics, I do think everyone should have some basic knowledge, even if you're engaging a tax practitioner to assist you. So first off, understanding this definition of net income for tax purposes. So we as individuals can have many sources of income. We can have employment income. We can have business income. So if we have a sole proprietorship, that is, we did not incorporate the business, then that business actually is one and the same. It's the same legal entity as us as an individual. And so they're earning self-employment, right? Sole proprietorship, independent contractor, right? But however way you want to call this, that is all business income that is captured here for the individual personal tax return. Maybe you have investment income. So this is ranging from like interest income, dividend income, rental income, royalty income even, right? So various passive streams of income that may be earned. If you sell these assets, okay, this is now where we talk about a gain or loss, but a gain for tax purposes actually is very favorable here in Canada. We still have hopefully that 50% inclusion rate. And so taxable capital gains will be included into that net income for tax purposes. And let's not forget about other income, anything else that needs to be captured, other deductions under Division B of our Income Tax Act will be captured here under net income for tax purposes. Okay, so once you arrive to that, then of course we need to make our way actually to taxable income, because taxable income is what drives the calculation. And so if you're ever curious, if you're ever asked on the phone, what is your taxable income? And they're talking about line 26000. which may or may not be the same as net income for tax purposes. So we can't assume that. So distinguishing the two lines, I think, is important. Reading your tax return accordingly, finding that number. And so if you have your net income for tax purposes, there may or may not talking about taxes truly. So preliminary taxes is what I call it, because we're using, of course, the marginal progressive tax rates we have here in Canada and calculating that preliminary number. But we then work very, very hard to reduce that number because, of course, we have many tax credits that can be applied that then offsets the preliminary taxes and then arrives to the actual net balance owing, or maybe a refund even. Okay, so that is just the basics covering that. Okay, so moving over to our sample case. Person J, we're going to work through their particular situation. So we'll say person J lives in beautiful British Columbia, Canada. They are born in 1981. They are single. That is their marital status. They are a Canadian resident, and here in Canada, we do run with the concept of residency, actually not citizenship, to dictate that exposure to Canadian taxes. And they, of course, then have a SIN. We'll use a dummy SIN here. We're not going to use any real data. Person J does earn employment income, which we'll see in the T4. So if you're earning employment income, your employer should be providing you with a T4. And here we're going to run with the number of $248,800 as their net employment income. This can include taxable benefits, taxable allowances. Person J also earns business income. So as I mentioned, that is another source of income that we might need to capture under that net income for tax purposes line. And so here they are not incorporating that business. It is a sole proprietorship. They're an independent contractor, right? So again, that language is quite important because we do need to capture this here in the personal tax return. And it's really just an extra form. So I have shared other recordings, again, when I was able to, right? Had a lot of issues with that one as well. In terms of how to populate that extra form, it is the T2125 form that is filed alongside the T1. And so really here, you're just tracking your revenues and expenses. So here we'll say person J has a net business income for tax purposes of $106,028. They also like to invest, so they're earning additional investment income. They have some dividends from their shares of, let's say, RBC. We know RBC, that is a Canadian publicly traded corporation. So 45,123 eligible dividends, and we will see that in their T5. Many of you will be receiving T5s that help you capture that information, right? You're not frantically keeping records of your bookkeeping, so relying on these slips probably. And this is not held in a TFSA or RRSP, so I can make another recording on this, but to be honest, there's so many great resources already out there distinguishing the power, the beauty of these tax advantaged accounts like the TFSA, like the RRSP. But for this simulation, we'll say it's not in there, therefore fully taxable. This individual also has shares or had shares of, let's say, Shopify, which is another Canadian publicly traded corporation. They sold it for a nice gain of $230,732. As I mentioned, half of this is taxable. We have very nice tax inclusion rates here in Canada still, despite June 2024 mishaps there. Anyways, so 50% inclusion rate. Now, mind you, again, this is taxable because it is not held in a TFSA or RRSP. What else do we have? Person J also has a lovely rental property in beautiful Predators Ridge, Vernon, BC, and they earned net rental income of $12,040. That is taxable. Okay, and this too is just captured in an extra form called a T776 as part of that T1. And so I don't think I have any resources on this one here. But again, rental revenues, less your rental expenditures, will get you that net rental income. Last but not least, we'll say person J does have a dependent 12-year-old who is eligible for the disability tax credit. So you do need that tax certificate issued by CRA. Person J's child earned some interest income, let's say $1,200 from a high yield savings account. All right, so again, lots of information, and this is just a simulation, a sample. Again, reminding you of the slips that I mentioned. T4, I'll show you here, box 14 again, is likely a number if you're using, you file tax file, Wealthsimple, right, to file your own taxes. You're then very familiar with this box 14 because it's sort of summarizing and capturing everything, all those taxable benefits, taxable allowances. I think what's important to note here is that you might rely on this, you might rely on your employer, but if it's not quite looking right to you, how was this number calculated? Because you are paying taxes on this number, then of course it's important to have that discussion with your employer, make sure everything is okay. And then, of course, using that number to file accordingly. T5, as mentioned, likely your financial institution will be issuing this. With that said, there are cases where they may not because the amount is so insignificant, but you still have to report on it. So, I mean, for 45,123, we definitely would expect a T5 slip. Again, you can see here eligible dividends. And actually, maybe I'll pause here because this is where, in the classroom anyways, we spend a great deal of time talking about tax integration. We talk about the technical concepts of the treatment for dividends. It's actually a little bit complicated, but maybe that's not of interest to you. Just for your reference, though, while this is the amount you might receive in cash, for tax purposes, we'll actually take the $62,270. This is a grossed up amount. It is grossed up at 38% federally for just that tax integration for that concept to prevail. So if you're ever curious why that number seems awfully high, again, it's not a mistake. It's likely the taxable number. With that said, there is a corresponding dividend tax credit that's, again, just its own calculation driven by the gross up, in this case, 6/11th on a federal level to get to that 9,353. So we know this number. You could probably cross-reference this number quite easily, but if you're ever curious where these numbers are coming from, that's, again, from a technical perspective, we could spend a few hours on that one there. But moving on, so just capturing what it is I just said. So we had employment income of $248,800. We had some business income. We had some property income. Again, the dividends and the taxable dividends and the rental income is all included here. The taxable capital gain, again, 50% inclusion rate. So hopefully that will remain the case. $115,366. In terms of other income, other deductions, I don't really want to dive into it here, but there is a little bit of a tax deduction. It's driven by that CPP. As of 2020, lots of changes, right? As of actually earlier than that, 2016, maybe many changes with the CPP program. Lots of thoughts on that, but as an outcome of that, we now have a tax deduction. We also have the tax credit, of course, but in this case, the tax deduction portion of that CPP, which is your contributions, actually, you, person J, being $1,074. There, $543,430 is the net income for tax purposes. Okay, so person J is doing very well. We're then going to take that number, double check if there's any division C deductions. And again, we don't have too many as individuals, but it might be applicable, which then can reduce that taxable income. In this case, this very simple case, we're going to say no. And so here we go. So we are using this 543430, that line 26000 to calculate the preliminary taxes. So I mean, well done, person J, right? Doing very well. And so here we're going to attempt to calculate the preliminary taxes. This is where you might be very happy to be using your tax software, because this is where the manual calculations get very overwhelming. But again, if you're interested, we'll go through that simulation here. So here on a federal level, and actually maybe I should qualify this recording, I'm only going to do the federal calculations. Here in BC, of course, we have provincial tax rates as well. But in terms of the calculation, I'm just going to walk through the federal. And so, yeah, as you may have heard, we have progressive tax brackets, progressive tax rates. And so every single year, so in 2025, which is the simulation, this example here, the first 57,375 is taxed at the lowest tax bracket. We then have the next incremental amount, so really the next 57,375 taxed at a higher tax bracket, 20.5% on a federal level, and so on, right? So some people really struggle with this concept right here, where they think, oh my gosh, I'm earning, right, 500 something thousand, I'm going to pay 33% on that, and that's not correct. That's a flat rate system. No, it's a progressive taxation system. So again, it's incrementally based, driven by your taxable income. And so, you know, it's not as frightening, I guess, as taking that 543,430 at 33%. That would be quite substantial, but we'll go through it line by line. I'll go through it anyways. And other than that, what else did I want to highlight here? 14.5%, if you saw that little note here, the Liberal government with that snap election did propose as part of their platform to reduce our historical 15%. So historically, our first tax bracket was at 15%, and they did propose to bring it down to 14% effective July 1st of 2025. Therefore, 2025, a bit of a strange year. We're at sort of 14.5%. Sorry, I just have to remove myself because I'm going to be blocking what it is I want to show. What was I saying? My thoughts on this is that we actually didn't receive royal assent for this change until quite late, I would say, in March 2026. And so, of course, you know, for true reality, we of course filed based on the 14.5%. But for students, candidates in the classroom, this was a bit of a struggle because we, you know, as we go through these technical, they're sort of caught by this delay. So anyways, I guess my point is, yes, 14.5%, but if you're so accustomed to that 15%, I'll maybe go through both examples here to just show that difference. Okay, other than that, what else did I want to say? I have the federal level here. Here in BC, as I mentioned, we do also have the provincial portion, of course. It has its own tax brackets. Okay, so again, we don't focus too much on those calculations in the classroom because we already have so much to tackle, right? Just fundamentally understanding the tax bracket system. I'll calculate the federal, but of course we also calculate, right? Your tax software anyways will calculate your provincial portion, and you will then owe the two. And that's why if you hear people complaining, right? Oh, I'm being taxed 50 something percent. They're talking about both the federal and provincial portion combined, of course. All right, so here you have a snapshot again if you're ever needing to check it out, right? CRA does publish this. So we have 2025, but this recording is being made, what date? What date are we at? June 2026. And so of course we're already in 2026. We have different tax brackets for our particular tax year, but just for this simulation, I'll stick to 2025. All right, so here I go. On the left, I'll use the traditional legacy rate of 15%, whereas on the right, I'll use the 14.5% that did pass into law March of 2026, retrospectively applied, of course. So here I go. Driven by that taxable income of 543,430. So the first 57,375 at the lowest tax rate, right, about $8,600. The next 57,375 is taxed slightly higher at that 20.5%. And then the next 63,132 is taxed at 26%. So notice here, it is incremental, right? Incremental amounts only. And so under the old calculation, right, this would be a preliminary tax amount of 154,391. Whereas, again, due to that change in 2025, effective July 1st, just a slight decrease, as you can see here, right? So again, slightly lower taxes as promised, right? They did promise that. So here you go. There you see it quantified. So again, 154,105. So I'll show you both. Anyway, so we have this number here. We have our preliminary tax, but what is important next is to, of course, calculate the tax credits. So with regards to these tax credits, there are many. And so this is where maybe as you work with a particular platform, and many of them are actually really great, like Wealthsimple, YouFile, right? They will prompt you. They might ask questions and then assist you with claiming the available tax credits. Or as you work with a tax practitioner, then of course they will guide you as well. But if you're curious, right, CRA does have some resources as well. And maybe I can pull this up. Let me give it a try. Okay, so I think I pulled it up here. We'll see if this works. So anyway, so this is the same website that I was just trying to show that snapshot of. But if you find it, right, CRA's website here, just kind of going through and maybe you can even filter for your particular circumstances, then they can give you a little bit of guidance as to what are some common tax credits that might be available for your particular situation. And as I'm scanning through this, I mean, I'm seeing some tax credits. I'm also seeing some deductions. Okay, so that's a little bit confusing. We're focusing right now on tax credits, and they've grouped it all together. So yeah, I think just being a little bit careful. But it's still a resource. I guess it still might give you some guidance in terms of what might be available to you. There you go, right? Actual tax credits. All right, not the best, but still a decent resource. I mean, this is where in the classroom we actually would spend a lot of time analyzing, but let me just give that to you. Okay, I'll save you some grief. I see 1, 2, 3, 4, 5, 6, 7, 8 for this particular individual. Okay, so the BPA is a tax credit that we all have access to, whereas CPP, EI, Canada Employment Amount is because our person J is an employee. We also have the eligible dependent given person J's marital status and the fact that they are provided care for a dependent, and that dependent does have access to the disability tax credit as well as the supplement due to their age, and they're able to transfer this to person J, and also the mentioned dividend tax credit. So again, this might be really above and beyond what you might need to know, right? The calculations, the base credits and whatnot. But again, the purpose of this recording is to just kind of give that background. So if you're using the 15% first tax bracket or you're using the 14.5, this is where the numbers might again be slightly different. I just want to show both because 2025 was a bit of a strange year. So the base, and maybe this is where actually I want to just clarify, these are some questions I get from time to time. They, individuals think that they can reduce their taxes by the base amount. So CPP 3356, EI 1077, and that's not correct. Many of these tax credits are calculated in a way that, yes, there's a base amount. It looks very attractive. It looks very substantial, but in actually calculating the tax credit, we have to apply that first tax bracket, which then brings this down quite substantially so that it's a dollar for dollar or apples to apples comparison offsetting the preliminary tax. Okay, so that's a misconception I do hear from time to time, so just clarifying that. The exception here, the dividend tax credit, the 9353 truly is the tax credit. We don't then further apply a rate to this amount. So again, if you're using the 15%, then this would get us 17,231. If instead you're using the updated 14.5%, which did pass into law March of 2026, then of course that number would be slightly lower at 16,968. So again, depending on your calculations. So if using that 15% first tax bracket, our conclusion, and I always tell my students, they have to really conclude, right? You have to answer the question, which is what is this person J's net federal taxes payable? In this case, federal portion only, and that is the 137,160, 137,160 in true taxes to be paid. And then if using instead the 14.5%, then this number, of course, is slightly lower at 137,137, 137,137. All right. So that is kind of the conclusion that I have here So that's the conclusion, I guess. That's what we were working towards for this for part one. So this 137 is the number that we should see hopefully in my next recording if things go well, where I'm using, let's say, Wealthsimple, which is, very accessible to many. And then if all the things go well, then I'll do one with my software. That's maybe more for my students who've been asking to see, true practitioner software in action. So that is the goal with software. And so maybe just the last few comments on this particular recording. I know I've been rambling for a while. For many individuals, if you have a very simple tax return, as in you're predominantly slip-based, maybe, it's very minimal, CRA does provide their simple file services. It used to be on the phone. I'm not sure what it is exactly now, but they are developing this because they are wanting to encourage people who may not have the means or funds to hire a practitioner to engage in this service. It is free. It is through the CRA to get their filing done because there might be many benefits that are available that are not being accessed because the filing hasn't been complete. And so that would be very unfortunate. So maybe this would be a good opportunity for some who, right, doesn't have a complicated case, doesn't need to hire a tax practitioner, but really should file because they can then access various resources. So that's one. Sorry, jumping over here to Wealthsimple. So I'm a fan of Wealthsimple. I think they're doing amazing, great things. And so they purchased, was it Simple Tax quite a few years ago? And then the idea here is that, you can pay what you want. And it looks like now they have options. Actually, you could pay a little bit more and have more features. But, basic probably is suffice for many, I would say. So that will be my next recording. Hopefully that works well. And in terms of the third recording, again, if things go well with that, I'll make a third one, which is software. And I use Tax Cycle. I've used many in the past, Profile, Tax Prep, if that's still around. But Tax Cycle is really great, I would say. I'm quite happy with them. And so we'll see how that goes. Otherwise, thank you for watching. I hope this was somewhat interesting. Right? As an individual taxpayer, just understanding a little bit more about your role, your responsibility, your obligations, and whether or not it's simple enough for you actually to give it a go, or actually you recognize that there is a lot of complexity and it might make the most sense to engage services. But just keeping in mind that at the end of the day, we are signing our name to something, regardless if a tax practitioner has been hired, there's an engagement, that ultimate responsibility, right? The CRA will be calling the taxpayer. And so just having a little bit more understanding as to what goes into the calculation, I think is always good, always a good idea. Thank you.